Hi, welcome to Chapter 12, Microeconomic and Industry Analysis. So in this chapter, we're going to talk about the global economy. So the global economy is something that most stocks will be affected by. So most stocks, even if the stock is limited to activities to one or a few countries, they're still going to be impacted by the overall economic activity of the global environment. Now, a top-down analysis is where we do a stock analysis where we look at the very largest economic indicators first and then file it down into an industry and then an individual stock. So the international economy is going to affect, of course, the company's exports, but also the outside international economy will affect how busy a internal economy will be, because even if your company doesn't export, other companies do export, and then with their proceeds they may increase purchases from your company even though your company is not a direct exporter, but they can still be influenced by other companies. Also, the price competition that they might face from foreign competitors in their domestic market. So all of this is interconnected and related to each other. Now, so that's why it's important to study not just the domestic, but also the global economy for its effect it can have overall on your business. So, the smallest level you have a local economy, then a domestic economy, then a regional, and then a global. So regional macroeconomic conditions are important too to consider, in valuing the economic performance of corporations across countries or regions. So it's not surprising for you to know that the stock market is going to be mostly going to be aligned with the economic expectations of the global economy. Although it may not be aligned at the same time sink, usually the market is ahead of the economy as far as reflecting the impact of where the economies are going. So stocks are driven by performance relative to previous expectations. And if economic growth is increasing, that's going to help companies' individual performance. So this global economy, one of the main aspects that companies have to worry about is exchange rate. So the exchange rate for the domestic currency and how it's converted into international or foreign currencies is also going to affect their purchasing power and the sell price ability. So if we look here at the economic performance, so we're looking here, this is the stock market returns in 2016 percentage. So we have the local currency in US dollars and the forecasted growth. So you can see that local currencies can change in relative strength to the US dollar. Some moving up, some moving down. So that's going to affect your overall returns on these companies if they're dealing with these foreign currencies or converting currencies into domestic currencies, because those exchange rates are going to change along with the global economy. Now, and in the global economy, there are many risks that come up, such as economic unions being formed, countries breaking or exiting from economic unions, Brexit being the best example of that. But when we talk about exchange rate or exchange rate risk, this is how, and if you've ever traveled, you know that their domestic currency is going to be converted into foreign currencies, and that's going to be a cost to the business. It's not converted for free. There is a transaction charge. But also, if something's sold in a foreign currency and that currency increases in value or decreases in value, it's going to change the amount of American dollars or euros that you're going to receive for that. So, of course, these exchange rates fluctuate a lot like stock prices fluctuate. So it's hard for businesses to always be able to predict where the exchange rates are moving, and that can have an effect on the overall impact or profits of the company. So that's why understanding the global market is important to know. So let's just go back to this previous slide. So in this previous slide, this is going to show more specifically the change in the purchasing power of the US dollar relative to the purchasing power of several other major currencies. And this is, we could look at it. You can see that it's not uniform. So the ratio of purchasing power, which is called the real or adjusted rate, inflation exchange rate, the change in the real exchange rate measured of how much more or less expensive the foreign currency or the foreign goods have become to the U.S. citizens. So why do we have these fluctuations in exchange? Well, let me just switch to figure. Because there is supply and demand aspects here as well. So if one currency is in demand, the value of that currency is going to go up. And the other currencies are in less demand, the value of those currencies will go down. And economic, political, social, or any type of news that's going to affect the overall value of the currency is going to create change in exchange rates versus the dollar. So here's just a look at the US dollar versus major currencies in this period, this 13-year period. So UK, Euro, and Japanese yen, Canadian dollar, as far as a percent change to, so you can see these changes are rather large. Now, there are, some countries that have a floating rate and some countries that have a fixed rate exchange. So, say for example, a country like Denmark will have a fixed rate exchange into the euro. So it's always going to be the same amount of crowns that equal a euro, but the euro floats against the dollar. And if the euro depreciates against the dollar, American goods could become more expensive. So all these economies are interrelated, and the currencies are going to fluctuate. Now, if a country abuses their currency and becomes less fiscally responsible with their budgets and their collection of taxes and their spending, currencies will devalue, and as a response, most countries will increase interest rates to try to make the currency more valuable and create more demand for the currency. And this generally can coincide with inflation at the same time, because as the currency devalues, foreign goods become more expensive, hence the increase of inflation in the economy. So let's look at some of the indicators of the domestic macroeconomy. Okay, so here we have gross domestic product, and the gross domestic product, this is what we say the broadest measure of an economy's performance. So measured every 3 months, and it depends on which government agency or which country, but some agency is going to be responsible for measuring this, and it's an estimate of the total currency value of all goods and services produced in a country. So we want to see the annual rate of growth. If there's growth or decline in real or constant currency value, the numbers estimated can affect by inflation, so it's measured by actual volume of production. So this is it's a lagging indicator, meaning that we get information from the past, but it's showing the growth of the overall growth of the economy. So it's a very important. Now, unemployment rate, this is the percentage of the workforce that is involuntarily out of work, or what we call unemployed. So it's a broad indicator of economic health by, excuse me, other monthly figures. This is usually issued by the Labor Department, who's going to look at the number of payroll jobs, and maybe if we have particular events in the economy like a recession or a shutdown, you're going to have change in unemployment rates. So the unemployment rate, if it's increasing, that's going to be a negative for the economy. And of course, if the unemployment rate is decreasing, it's a positive for the economy. If we look at inflation as an indicator, this is basically giving us the level of prices for goods and services in the economy, showing that the prices are rising. So the cost of buying groceries, going to the movie theater, buying gas, petro, these are all going to be subject to inflation. Now, some things grow faster, some items may grow faster than others, but definitely the rate of inflation is, if it's too high, it's a negative for the economy because it erodes the purchasing power of its citizens. Interest rates, of course, these are going to affect this is something you want to watch because this will affect the value of future cash flows. So if interest rates go up, it's going to make the value of future cash less valuable, as that future cash is going to be discounted at a higher rate. It can also affect economic activity because you have higher interest rates mean fewer people can afford home and auto loans or credit card debt. So it may also affect the economic activity by limiting how much people can put on credit. Now, when we talk about a budget deficit, this is the look at all the government spending in excess of the government revenues. So if a government is in a deficit position, they're spending more than they're receiving in revenues. And in this day and age, many governments do run a deficit on an annual basis that contributes to the national debt. Now, there's a certain level, just like in an individual, a certain level of debt is acceptable and deemed normal, where you're really just moving future revenues to the present so you could make investments to hopefully generate more future revenues. So if the borrowing is for good infrastructure and other educational good investments, it should pay off in the future. But if this money is wasted on wasteful military builds-up or wars or corruption, this is going to lead a country to become more unstable and more economically less valuable. Okay, consumer sentiment. So here we're looking at how the consumers are feeling about the economy. So it's measured in, it's sort of an optimistic or pessimistic sort of scale. So of course we want, if consumer sentiment is increasing, that means they're more confident with the economy and their situation, and they may be more encouraged to spend more. Okay, so if we look at this graph here, the S&P 500 index versus earnings per share, this is where we could see a relationship. Here's the black is the S&P 500, and you can see that we have 12 times, 18 times, and 25 times earnings per share listed out. And you can see that in a rare occasion, the S&P 500 is above 25 earnings per share. And usually during a stock market bubble, the S&P 500 will trade above the 12, 18, and in a very rare case, the 25 level of earnings per share. So here we see that in this particular region, we have the S&P 500 getting dangerously close to the 25 times earnings, which would show an overvalued state, potentially leading to a stock market crash. So the stock market, earnings per share is a measure of profits that companies generate, which is a measure of economic activity. So if the earnings per share are going up, that's a good thing, and stock prices generally go up along with earnings per share. But if earnings per share go up too fast, then that could be an issue. Okay, so just a couple other economic indicators we may want to think about. There's also industrial production, which is going to look at, it's issued monthly. It's going to track the output of factories, mines, gas and electric companies, and this is trying to see what the industrial production is, and this is a good leading indicator. So it's a good guide to business conditions between reports of GDP to see how the economy is moving. Personal income, which would be a report of the before-tax income received in the form of wages and salaries, interest and dividends, rents and other payments, and Social Security or pensions for individuals. So it gives you an idea, is personal income growing or decreasing? Retail sales is an interesting area to look at to see what the level of retail sales are. Retail sales increasing or decreasing, what people buy in stores. Producer prices, which is related to inflation. Consumer prices, which are both related to inflation as how it's measured. housing starts, how many new housing constructions for domestic or even commercial constructions are being started, because that could be a leading indicator for economic activity. So all these things are good ways that we can measure and sort of get a predictability of where the economy is going. Let's talk about interest rates a little bit more closely. So interest rates are a key factor in the performance of economies. Now, so if you are a saver, you would be what we call a supplier of funds, and you're going to receive an interest rate on your savings. If you're a demander of funds, we call you a borrower. And if you're borrowing money, you're going to pay a rate of interest on the money that you borrow to the supplier. So governments generally can be either a net supplier or demander for funds. Most governments are a net demander for funds. And the rate of inflation is going to affect the interest rate. So if inflation is expected to go up or is going up, that's going to promote central banks to raise interest rates to combat inflation, which is one of their number one goals. Because they don't want, inflation is an economy destroyer. It's an economic destroyer. So the central banks typically work very hard as one of their main goals to reduce inflation, and raising interest rates is the fastest way of doing that. So here in this particular chart, you can see the equilibrium between real interest rate, the real rate of interest. So here we have an equilibrium of interest rate and net funds lent. So this is, at this point, the interest rate will significantly encourage enough people to supply funds for what needs to be borrowed. Now, if the demand for funds increases, then interest rates are going to have to increase to encourage more people to save money so they can be lent out. So when demand for borrowing increases, interest rates, there won't be enough money. If there's enough money to be lent, then interest rates need to be increased to entice people to borrow, to lend more money to people who want to borrow it. Now, we have this demand shock and supply shock. So demand shock is an event that affects the demand for goods and services in the economy. So if there's some sort of economic slowdown or shutdown, this will greatly reduce the amount of demand for goods and services in the economy. Now, a supply shock, this is events that will influence production capacity and the cost in the economy. So, supply, and this is the fundamental of a lot of investments, is supply and demand. So if you have a situation where there is a disruption or a shock in either of these areas, this could be very detrimental to the economy. So your shocks can be, some sort of reduction in tax rates. For, say, a demand shock, reduction in tax rates, increase in money supply, increase in governmental spending. That would be a demand shock. So usually if, say, the economy is faltering, the government may try to create a demand shock by handing out money to the citizens or lowering tax rates. In a supply shock, this could be severe changes to energy prices, which could be brought on by, say, weather, floods, freezing, droughts, agricultural, we're talking about farming crops being destroyed. These things can create a supply shock. And, when supply shocks, usually we characterize them as aggregate output moving in the opposite direction of inflation and interest rates. So say a big increase in the price of imported oil is inflationary because the cost of production rises and leads to the increases in prices of finished goods. So I'd say oil prices going up greatly could be a huge demand to supply. Now, the opposite, if oil prices decline, that could be a demand shock, because that would give citizens who typically pay a lot of money when the oil is converted into usable fuels like home heating oil or petro or airline jet fuel. This is going to reduce the price. A decline in oil prices reduce the price that consumers are paying for this number one energy source, which gives them more money to spend on other things. So this is an important thing, because if you analyze these supply shocks, demand shocks, you can have better pinpoint which companies will benefit or be detrimented by these changes. Okay, so let's look at government policy. And this could be, government policy, this could be any government, really. So the names of institutions and the abilities of different institutions to do different things may be slightly different, but this is going to be from the U.S. point of view. So fiscal policy, the use of government spending for taxing and stabilizing the economy. So fiscal policy, governments have a broad ability to change the laws or change their actions that could affect the government spending, could affect the taxes they place, could affect tariffs on products. So fiscal policy is the most direct way to either stimulate or slow down an economy. And, if you decrease your government spending, that's going to reduce demand for goods and services. Now, if you increase government spending, that's going to create additional demand and can, be the creation of many jobs, many business opportunities. Also changes in tax rates. The U.S. recently lowered their corporate tax from as high as 39% down to 21%. And this had an immediate effect on increasing economic activity. Now, fiscal policy is a way for the government can kind of manipulate the economy and have an immediate impact on the economy. So the implementation of this policy can sort of be slow, painful, and not always achieve the desired results. So there's enormous amount of compromise between the how the government is what they're trying to achieve and the different tools they can use, and the government bodies and businesses that are going to be affected through this. So tax and spending policy, must be initiated by a governmental action that's going to require typically a lot of political negotiations and cooperation. So it's not something that's done too often or too easily. Now, government spending is generally, the government is one of the biggest influences any domestic economy because their spending on social programs is quite large. And so they're going to need help from many businesses to achieve a lot of the purchases or the money they're moving around in the economy. So these are all things that are greatly going to affect the economy. Now, if you look at monetary policy, this is something that a central bank or the Federal Reserve can do to influence the money supply and interest rates. So now, their goal is to maintain low inflation and full employment, but these monetary policy or actions that they can take, that they can decide to increase the money supply or lower the money supply. They can change the short-term interest rates, encouraging investment and consumption, or discouraging investment and consumption. So these actions are meant to try to mitigate big swings in economic cycles, booms and busts, and try to facilitate a more balanced economy. So, the monetary policy is a very difficult ship to maneuver, and it takes, a long time to turn, just like a very big boat would take a long time to stop and turn around and go in the opposite direction. It's the same thing for the economy. So it can be cumbersome to implement, and fairly difficult to monitor, and takes a long time to see the immediate results. But, it's one of the actions governments have been trying to modify and refine over the last 100 years to protect the economy and the citizens from economic collapse, or that can lead from inflation or different shocks to the system. Now, and the Federal Reserve or central banks have a number of tools that they can use as far as expanding their balance sheets, manipulating interest rates, setting the discount rate, creating reserve requirements for banks. So there's a lot that they can do to try to affect the results of the economy. Now, supply side policies. Here, if you look at the fiscal policy and monetary policy, these are more demand-oriented tools. that's going to affect the economy by stimulating demand for goods and services. And the impact or the belief is the economy will not by itself arrive at full employment equilibrium that is so beneficial for the economic goals of any government. So the supply side policies are going to treat the issue of productive capacity in the economy. So the goal is to create an environment in which workers and owners have the capital to have the maximum incentive and ability to produce and develop goods. So with the supply side, economists also pay considerable attention to tax policy. While demand side is looking more at the effect of taxes in consumption demand, supply side is looking at the incentives and the marginal tax rates. So the usual argument is if you lower tax rates, more will encourage more investment and improvement and incentive to work. So this is sort of like what we call what Ronald Reagan, President of the United States, said: trickle down economics. This supply side economics is sort of what you want to do is if you lower people's taxes, businesses will say, oh well, this is going to give me more money to reinvest in my business and grow my business. Now, if you imagine having a tax rate of 90%, so why would you work if 90% of your money is going to be taxed? So maybe the first, certain amount of money you have low taxes, then after say 50,000 euros, now you're going to be taxed at 90%. People would not be so encouraged to continue working if additional efforts would be taxed so highly. So people may decide not to work their overtime. They may decide not to have a second job. So this is why very progressive, heavy tax systems may reduce the incentive to work. So supply side would say lower personal taxes and encourage people to work more or start businesses. Okay, let's talk about the business cycle. So the business cycle is a pretty common effect where businesses don't just chug along at the same economic activity month after month. There's changes. And if you plot these changes over a time period, a time scale, you notice a significant change in the business cycle. So, as far as like economic analysis, one of the first steps we want to look at is the business cycle. So it sets the tone for the entire securities analysis process. So if the economic future looks bleak, we're going to expect more dismal stock returns, or if the future economy is not going to be good, then the future stock returns are not going to be good. So if the economy does look strong, then stocks will do well. So the behavior is captured in this business cycle. So it's a series of alternating contractions and expansions, which reflects changes in the total economic activity over time. So now, two of the measures that we can measure the business cycle is going to be gross domestic product and industrial production. And this is what's going to measure those alternating contractions and expansions that make up the business cycle over time. So we talked about the gross domestic product before, and it's going to be the measure of all goods and services produced in the country over a given period. So when economists say that the economy is in recession, it means the gross domestic product has been contracting for at least 2 consecutive quarters. That's how we would define a recession. So on the other hand, an economic expansion generally refers to a period where the GDP is growing. So industrial production is an indicator of the output produced by the industrial firms and companies. So normally the GDP and the index of industrial production move up and down with the business cycle. Okay, and we'll have a peak and a trout. So so it's going to come to the next slide. It's going to show the peak and the trout. So the transition from expansion to contraction, and the trout's the transition from recession to recovery. So here, this is a pretty classic chart where we see the peak of the economy, followed by a contraction, a trout, and then expansion, peak. So this cycle just keeps repeating, and the governments are going to try to smooth out this cycle. They can't eliminate it completely, but what they want to do is expand the length of expansions and reduce the length of contractions, or increase the peaks of expansion and reduce the trough of contractions. Now, and as we talked about before, things that are going to affect this business cycle, of course, are going to be inflation, consumer spending, business investments, foreign trade, foreign exchange, monetary policies, money supply, interest rates, taxes, government spending, debt management. These are all things that affect the economy. So we have different types of industries. So we have cyclical and defensive industries. So cyclical industries are industries with above average sensitivity to the economy, where defensive industries have below average sensitivity. So cyclical stocks are issued by companies whose earnings are closely linked to the overall economy. They tend to move up and down with the business cycle. So companies that serve markets tied to capital equipment spending by businesses. So capital equipment is like the big machinery and equipment that companies would use to expand capacity. Or consumer spending for big ticket items, durable items like houses, cars, boats. These are typically cyclical stocks. Something like Caterpillar is a good example. Caterpillar makes big construction equipment, so they'd be very cyclical. And cyclical stocks generally do well when the economy is moving ahead. They tend to do especially well when a country is in the early stages of economic recovery. And they perform poorly when the economy begins to weaken. So these are all companies that if the economy is booming, people feel confident, they'll make those bigger ticket items, buying a boat, buying a larger house, buying a more expensive car, investing in these big ticket items that they can put off if times are bad. And that leads us to defensive stocks. So it's possible to find stocks whose prices remain stable or even increase when the general economic activity is tapering off. So these securities are known as defensive stocks. They tend to be less speculative and less susceptible to downswings in the business cycle than the average stock. Defensive stocks include shares of many public utilities, industrial consumer goods, companies that produce or market staples, beverages, foods, drugs. So examples might be like Walmart, Kraft Heinz, WD-40, which is a maker of a lubricant. So these are all defensive plays that people aren't going to buy less of something. So usually prescription drugs, people are going to stop the prescription drugs if there's a recession, if they can help it. And when it comes to food or beverages, beer, wine, staple foods, these aren't going to be reduced because people are still going to have to eat. Now, high-end restaurants may have a reduction. High-end restaurants would be more cyclical, but lower-end fast food might be more defensive in how they react to changes in the economic activity. So those are important to remember. Okay, so if we look at this leading indicators, so if you look at this blue line, the leading indicators ramp up, that's economic expansion. When they start to pull back, it usually leads to a recession. So the bigger the increase of the leading indicators, usually the bigger the expansion. So as soon as they start to trail lower, that's a good indicator that there'll be a recession. And if you were to finish this chart, you would see that this is going to go back down again, and then in 2020, there's a recession. So leading indicators are a good measure of where the economy is heading. So let's look at some leading indicators. So this is the economic series that tend to rise or fall in advance of the rest of the economy. So here are some things that we could look at to give us an idea of where the economy is going. Average weekly hours of production workers. So are workers working more overtime? If they're generally working more, then the economy is going to expand. If they're working less, it's an indicator the economy is pulling back as demand is slowed. Initial claims for unemployment insurance. As these initial claims increase, then we're going to have a reduction in economic activity because they're not going to be working and they're going to be living on a reduced amount of unemployment income and a reduced incentive to purchase things. Manufacturing new orders, of course, more new orders is good for the economy, leading indicator. The money management index for new orders, looking at, again, new orders and their impact. New orders for non-defense capital goods. Of course, any of these new orders increase is going to be, because orders get placed, but they don't get built or shipped until later. So if orders are going up, then their impact is going to affect the economy months later. So that's why I want to see an increase in these new orders. New private housing units being authorized for building permits. More building is going to expand the economy. But the permits get issued first, and later on they're built and expand the economy. That's why they're a leading indicator. Yield curve, something we covered in the last chapter, looking at the spread between the 10-year bond and the federal funds rate. So typically, like we talked about last chapter in bonds, if there's an upward sloping yield curve, that's favorable to the economy as a leading indicator. Stock prices, if stock prices are increasing, that's a leading indicator that the economy will be doing better moving forward. Growth in the money supply, increased money supply should be an increase in economic activity. And index of consumer expectations for business conditions. So these are all things that we can measure these early, and then they translate into economic activity later. So that's why I call them leading indicators. To continue this slide. Employees on non-agricultural payrolls. So if employees are increasing that are not on the farms. Personal income, less transfer payments. So just really looking at net personal income, if that's increasing. The industrial production, manufacturing, and trade sales. These are all things we can look at to give us an idea of where the economy is going. So if you're an economist, these are things that you're going to measure, track, and try to utilize in predicting where GDP growth is going to come into later in that year. So things that we could also look at, these would be now lagging indicators that would be would come after or behind the fall of the economy. So basically the economic recession or fall happens and these indicators confirm it. So the duration of unemployment, how long the average unemployment is, ratio of trade inventories to sales, because we're trying to measure how fast inventories are increasing. So that's usually bad for the economy if inventories are increasing. Change in the index of labor costs per unit of output. So we're looking to see if labor costs go up, average prime rate charged by banks, the commercial and industrial loans outstanding, ratio of consumer installment credit outstanding to personal income, and change in consumer price index for services. So all of these, as they're changing, will show us that, okay, the economy has gotten worse. Consumers are, piling on more credit, or, prime rates are changing, inventories are changing. So these are things that we can look at and point to, okay, definitely the economy contracted. This is just a slide of an economic calendar, and this is different for different countries as far as when different reports are released in what part of the year. And this is from Yahoo, other economic calendars and indicators. And again, it depends on what country, because these are usually issued by country. Okay, so let's move to industry analysis. So in the top-down approach, we first start with economic analysis. And if the economy looks good, that's going to point us to a certain set of industries that we should start looking at. So the next step is industry analysis. In industry, we have codes that are going to classify what stocks fall into which industry groups. And then we could look at these industry groups and see how sensitive they are to the business cycle. And so related to where the business cycle is, what is there going to be the effect on their sales, their operating leverage, their financial leverage. Here is an example of some codes where you could put classifications of businesses in. So this sort of have a little bit of a number logic in it. So the first two digits just indicate all companies in construction, and then the 6 is going to indicate construction of buildings, the 1 a residential construction, and then other sub-facets of residential and non-residential. So you can see how it has a numeric logic to how the numbers for the codes are laid out. Okay, so return on equity. So equity is the amount of money, capital, that's invested in the company by the investors. So it's either equity or debt. So we want to look at the return on the equity based on the different industry. And we see that some industries have a much higher return on equity than other industries. And that could affect how you're going to invest, because you would want to invest in companies that have a higher return on equity, because that's the return on the money, the stock capital in the business. Stock price performance, this is of 2016. So you see that airlines were at the top of performance in 2016, but if you look in 2020, they're at the bottom of performance. So that's going to reflect, airlines usually do well in the later parts of an economic expansion, and they do very poorly in the beginning of an economic contraction. And that's the same for a lot of these. We're about 6 or 7 years into an economic expansion here, and a lot of these industries here that did very well, you'll see them reversing in the next contraction. So this is a way we can kind of look at stock price performance in relationship to where the economic cycle is. So if you go through a number of economic cycles, you'll be able to plot which industries do well at what point of the economic cycle. So if you can identify where the economic cycle is and where it's likely headed, you can plot your investments for different industries at that point. So we could look here at 2013 versus 2016, and you see there's quite a difference in some of the rates of return between these different years. All right. Here we have the return on equity for software firms. So we see that in this particular slide, I'm not sure what year it's from, that some number of these companies are doing well. SAP is a software for business. Computer Associates is software for business. These are all pretty much softwares, mostly for business, although they do have some consumer level. So this is going to change if the economy is expanding and businesses have the money for reinvestment, a lot of that money is going to be sent to the software companies. But when the economy contracts, money to these software companies on the business side will start to be reduced. Okay. So if we look at grocery and jewelry as sort of a defensive and cyclical industry. So this jewelry is very cyclical. So meaning that if you feel wealthy and you have money, you might be buying diamond rings and bracelets and gold chains, but that's something you could easily stop to buy when the economy is a little shaky and not sure about your income flow. But groceries typically are much less impacted by economic activity than jewelry. So you can see in the stock market recessions and stock market crashes of 2000, 2001, and 2008, 2009, a huge decrease in demand for jewelry followed by an increase, where we do have changes in grocery, but they're smoothed out more. Because this again is related to the peak in the trout of the business cycle. Now, as far as in industry analysis, doing a sector rotation, so shifting portfolios from one industry to another industry based on economic changes. So we look at the economic forecast, and we might be shifting from cyclicals into defensive, or defensive back into cyclicals, looking at the peak and the trout. So after the peak, defensive industries often perform better. So in the trout, capital goods industries often perform better. In the expansion, cyclical industries often perform better. So we could do the sector rotation of industries in our portfolios depending on where the economy is. So here is the expansion contraction wheel. So we could see that as the economy, the cycle goes on of expansion and contraction, there are different industries that are going to take advantage as this contraction moves on. And this is just kind of just a chart of how that sector rotation could work. So if we look at industry life cycles here, we're going to be measuring how companies change throughout the life of their corporate cycle. So how I would look at this is, when we're talking about this growth cycle, it's going to reflect the different industries over time. So if you kind of more generalized every company into one industry, it'd be different between different industries, but if we do it in more general terms, we could say there's an initial development. So there's an investment opportunity where the company is starting out. So the industry is new and untried and the risks are high. So this could have been Netflix when they first started streaming video content, Amazon when they first started selling over the internet. These would be, that's those particular years where they started up, that'd be the initial development. The second stage is more of a rapid expansion during which products accepted, people realize the value of the product, investors see that the industry is going to have some future growth. So at this stage, the economic and financial variables have little to do with the overall industry's performance. People are just excited for this rapid growth in sales, and stock prices move up pretty quickly. So investors will be interested in investing almost regardless of the economic climate, recession, depression, expansion, because these are such powerful forces. A new technology or a new company with a new way of doing things that are catching on, it supersedes the economic activity. So this phase of substantial interest in the product is going to draw investors to the company, and we see stock prices greatly increase during these periods. So unfortunately, most industries do not experience rapid growth for long. Instead, they usually slip into the next category of growth, which is more of a mature growth. And this is one influenced by economic development. So mature growth, you're going to be more subject to economic changes. So the expansion comes from growth of the economy, and it's slower when the overall growth of the economy is slowing. So the nature of the industry is going to affect it, of course, as well. But then at some point, it's going to enter a stage of stability and followed by decline. So in the decline phase, demand for the industry's products are going to be diminishing and companies are going to be leaving the industry. Investment opportunities at this stage are almost non-existent. So unless you're seeking only dividends, growth-oriented investors are going to stay away from this part of the cycle. So you could think of a new business. Let's talk about, say, DVDs. So there's this initial starter stage of DVDs where it's a new technology, DVD players and DVDs are being created, and then eventually leaders start to emerge in the industry, and a few companies come out with a format that's supported and maintain most of the business. And then it sort of matures where it reaches its peak potential. Everybody wants a DVR player, has one, and the DVD sales are a certain peak, and then that moves on a particular while, and then a relative decline. So a new could be a disruptive technology like streaming comes into play, or subscriptions, and then there's a relative decline. So the growth starts to decline and shrink faster than the rest of the economy as people move to the new technology or the new solution. So you could see, hopefully, so companies, that's why companies usually have a multitude of different products or product lines. So you could look at not just they could be one industry that's in decline. So at one point, cigarette smoking in some countries were in decline. So then started moving into vaping was expanding. So cigarette companies like Philip Morris will buy a vaping company to try to maintain their business, as they know that one thing is contracting, move into something that's expanding. Okay, so here's a nice chart where if this curve is really sales. So sales starts to rapidly increase in growth as the product or goods or services are new and taking on and starting to become bigger. So maybe it's electric cars, and as a new sort of rapidly growing product that's now moving into a stable growth, and eventually into a slowing growth as all car manufacturers are offering electric vehicles. But eventually there could be a minimal or a negative growth. Maybe a new technology comes out, fuel cell technology or something that's going to replace the electric car. Or, well, I guess a fuel cell could be used in an electric car. Maybe a new type of engine or a new mode of transportation. Okay. So if we look at industry structure and performance, so if you're in a industry, what's the threat of a new entry? So what's the threat of the ability of a new company to come in and pressure prices and profits? So if you have a rivalry between existing competitors, market share competition pressures for price and profit. So that's basically when you have more competition. So you could kind of think about some industries, it may be very difficult to for a competitor to move in. So maybe it's a railroad industry where it's going to be very difficult for a competitor to come in, lay their own tracks and run their own trains. Or if you have a high competition between a few firms, they may undercut each other's prices to try to gain market share, thereby affecting profits. And then there's also pressure from substitute products. So, for example, if you think about soda and sugared carbonated beverages, a substitute product might be water. So it solves the need for thirst, but it's done in a different product class. So maybe the need for cars are going to be affected by the introduction of motorized bicycles. So they're not the same, one's a substitute for the other. Or public transportation. So these are things that can affect the performance and structure of an industry. Now the bargaining power of buyers. So if you are a company that relies on only a few buyers, they're going to have bargaining power over you to negotiate prices. Now the bargaining power of suppliers is if you're selling a product and you only have a few suppliers, they may have the ability to push up prices on you. So this is going to affect, of course, your performance. So you get a company like Walmart is going to have a huge amount of bargaining power as a buyer. So they're a large-scale buyer, and they can really put pressure on their suppliers to lower prices. And other smaller companies may have, their suppliers may have more of bargaining power. So it really depends on the size and position of your company within the industry. All right, so let's skip that slide. Okay. So this last slide is just another economic calendar that it really is depending on. This is for the U.S. economic calendar. But to sum up this chapter, if you're going to do stock analysis and you want to find out which are the best companies to buy, so you're sitting there, first thing you should do with this top-down approach is you look at the economy. Is the economy expanding or contracting? That will lead you to which industries you should be looking at. So when you look at the various industries and you pick a few industries that are saying, okay, these are set to do well in this current economic situation, then you move into the stocks in the industry. And then you can do a technical analysis or a fundamental analysis on the stocks in the industry to see which companies are going to be the best to purchase. So moving forward, we're going to be talking about, equity valuation and financial statement analysis and fundamental analysis to get an idea of which companies are the best to buy. So we know where the economy is, we know the industries is going to do well. Now we can look at the 40 to 100 companies in the industry and try to pare it down to the top 10 companies using fundamental technical valuation processes to see which of these companies would be the best investment in the group. So what we're trying to do is whittle down the universe of, say, 10,000 companies, cut that down to the number of companies doing well during economic expansions and industries doing well to the economic expansions, and then cut that down to the bottom, the few companies that are going to do best within those industries in this current economic environment. Okay, so that is Chapter 12. I hope you enjoyed it, and I look forward to talking to you during Chapter 13. Thank you. Take care.